In today's video I want to discuss oil, and so what I'm looking at is the USO chart on the intraday basis. So we're looking at the 10-minute chart, and today, and again this is on the 17th of February 2015, but at the same time I want to use this video as education for any time frame whenever you're watching this. What happened was we put in a little bit of a low right here, and then we had this monster day on the USO. Just to think about it, we gapped down from about 1962 in the morning. We went here and went as low as right here where this hammer candle is, 1911. Now in terms of percentages, just think about it. To go from 1962 to down here 1911, that area right here, that is huge in terms of percentages. And as if that wasn't enough, this hammer candle didn't hold up. We went down further and went to 1899, essentially breaking that whole number. But thereafter we were off to the races, and so we surpassed this pivot right here where we opened. We surpassed the gap fill right here, and we closed at a very good part of the day. So we did have this monster move. We gave some of it back, but either way, a very impressive move. And so how would a trader think about this? So you have to think about technical analysis. So let's assume that you're seeing it in the morning, it's 9:30, and you have this monster candle immediately within the first 10 minutes. And what we need to think about is how do we put together several factors that are going to increase our probabilities. I don't want to take a trade that is the equivalent of flipping a coin and then maybe I get it and maybe I don't, because I know my emotions are working against me. So I need to do something to prevent myself from getting in that situation where my emotions are getting the best of me and I'm sitting there in a losing trade. And you do that before you even enter a trade, and that is you think about all the factors you can come up with, and then you put them all together, and hopefully that will be your high percentage winning trade. So at this moment it was about 9:30, 9:40 in the morning. We gapped down, put in this wide range bar. Definitely everything is bearish. We did, however, put in this hammer candle right here. So if I zoom in on it, now most of you who read books on technical analysis know that this is a hammer candle. But when something is too easy and too good to be true, it usually is. And so when you see these hammer candles, they alone cannot be enough because too many people know about them. So you need to keep adding factors and additional reasons why you should enter the trade. And I did have those. So we had the hammer candle, we had the 200 moving average, which is this red line. We also had this previous gap fill right here. So that immediately are three different factors. So that alone would have been enough to enter a trade. But notice how it would have also been an aggressive trade. And here are some of the things that would have worked against you. So when you're trying to trade, when you're trying to enter a trade, you need to look at the pros and the cons. So the pros were three different factors. We had the hammer candle, 200 moving average, and a gap fill. Very solid reasons. But at the same time, there were a few question marks. One of them was this volume. When you want to see a reversal, you want to see buyers coming in, and we just did not have that volume right here. So that is one very important reason. And also another reason, and this is one small little secret. When you're a new trader, at least this is my advice to you, you don't have to take it, but from experience, I have noticed that only the pros can trade during the first 10 minutes of the trade of the day. Why? Because that is when everybody is involved in the market. That's when you have the amateur traders, the scalpers, the day traders, the swing traders, the big funds, the big investors, the institutions, the high frequency traders, the computer traders, the algorithms. Everybody in the morning, as soon as the market opens up, is doing their thing, and they know that what they're doing is right. So they had their game plan, and so immediately at the onset, at the beginning of each trading day, you have pretty much everybody participating in the markets. The problem, however, is that us, as regular retail traders, we don't have the resources and we don't have the information that these big institutions have. And so when they decide on something, it's going to be very easy to get taken out when you're a small trader. And that's why I say, when you're a beginner, try to just sit there and observe the market between 9:30 and 9:40. And then if you see something, then think about possibly entering a trade. A lot of people, they think that somehow there's this big trade that's just going to get away from them, and therefore I have to be in on the market at 9:31 in the morning. It's not like that at all. So my advice to you is, especially when you see these big gap downs and then wide range bars, wait a little bit. So here's the key. You wake up in the morning, the market's open at 9:30. If you see these gap downs and then these wide range bars, no matter how good this level would have been, wait a little bit. Or what you can do, and again, this is what I do. If I notice that it's still really early in the morning and I haven't figured out what the pattern is, but I still have these kinds of factors which are pretty solid, I pick up half a position. And then I just leave it alone, and then depending on how that situation unfolds, I either exit if I don't like it, or I pick up the rest of the trades of the shares that I want. So that's my advice to you. So here's what happened. Again, we did have solid trades, but it was the problem of it being too early on the day, and there were key players in the markets who wanted to push it just a little bit lower. But that didn't necessarily mean that we were going to sell off. So the buyers attempted very weakly to get above this 200 moving average, but they couldn't keep it there. So we put in this candle, right? It isn't quite the same as a hammer, but notice how the wicks were towards the bottom. So that would have been a semi-bullish candle. Not exactly the strongest candle, but it would have been okay. And especially okay if you go back and you look at some of these other areas where we've had some action going on. So some arguments start arising in this area. But the most important arguments are these. A whole number, which is 19. Okay? A lot of people, when they put in their orders, they walk away, they go to work. Guess what numbers they put in their buy orders? 19.00. And so that was one factor. And another factor, again, you'll notice this in my videos, I use this as confirmation. My CCI was below minus 100, and my stochastics were below 20. And that would have confirmed that the USO was finally ready to go to the upside. And notice how here, as we started getting more and more candles, we started getting these wicks to the downside, meaning that the buyers were able to push it to the higher end of the candlestick. We struggled a little bit around the 20 moving average, a little bit around this area, but ultimately we broke out with conviction and closed here around the 1980 area. So that's how you have to think as a trader. But there's one thing I want to show you, And that is a little bit of a change in character in oil. Now this week is options expiration week. Today is a Tuesday and tomorrow is Whipsaw Wednesday. And so you have to be a little bit cautious, because a lot of times when you're in options expiration week, a lot of the times things that you think will work out don't work out, right? Because you don't see every piece of information that the big institutions do. And so you have to be careful, take a smaller position size, but still rely on your technical analysis. Just be more cautious and be aware. What I want to do is I want to go back to the 60-minute chart and show you a little bit of a change that is occurring. So again, what we just looked at was today, and that would have been just these 7 candles right here. We had that gap down. This is the $19 area where we bounced, and then we had a very strong up move. But what I'm noticing is that these last 2 days, meaning Friday, February 13th, and today, which is Tuesday, February 17th, are repeating. And that's what I like to do. I like to look at previous areas in the charts and see where key areas are, where there was something similar, something familiar in the charts. So if we go back here and we go to the 3rd of February, notice how we had a very strong up move. We had this wick right here. Now this area right here is some resistance that I talked about in previous videos. We almost came into it, but then we closed the day right here around the 1962 area. Notice how today this is where we gapped down from. So in other words, this is where we closed on Friday, and then today we gapped down here. So essentially we opened around the 1937. But what's important is the Friday close, which is 1962, and that was the same area where we closed on the 3rd of February. Very similar. Now, the next session, which is the 4th, we gapped down just like yesterday. But notice how we gapped down all the way down here at 1907. So even though the previous session's close on both days was on 1962 right here and right here, on the 4th of February that gap was much bigger. So we opened around the 1908 area. And then we had this drastic sell-off all the way to $18. And then we reversed, okay? But it took another day to reverse. It didn't happen intraday. And so the whole day, pretty much, we sold on the 4th of February. And let me put that in these sort of rectangles so you know what I'm talking about. So here is a reaction that we had on the 4th. So we closed right here at 1962, and the 4th, meaning the next session, the 4th of February, we had a major gap down and then sold almost the entire day. Then we reversed a little bit, okay, the next session, which is on the 5th of February. Then the 6th of February, we were floating a little bit higher, but nothing too much. But what we need to do now is look at the next area, which is this area right here, the 9th of February. So we're going from the 3rd to the 9th, and we're comparing. The 3rd was a Tuesday, the 9th was a Monday, and today being the 17th is a Tuesday. So notice how this is almost the same, right? As far as the time in the week. All of this is happening early in the week. So here, what happened? We gapped up, okay? We had bullish consolidation, not quite similar to what we had on the 3rd, but they're at least trading in the same range. And notice these wicks, they're both putting in, both of these days are putting these high wicks, meaning that the buyers are trying, but they're having a hard time. But at least here they're sticking around in a consolidation. Notice how here we closed around 1974. Again, close to that 1962 area. But what happened the next day is important. We had a gap down, similar to here, but it was a much smaller gap down. However, that gap down, again, was given up because we had a huge wide range bar. But notice where it came. It came right here around the 1904 area. Same thing on the 4th of February. We opened up, or we closed that candle, rather that 60-minute candle, so meaning at 10:30 in the morning, we closed it around the 1904, 1905. So this area right here, the 1905 area, seems to be an important area. And then notice how here we sold off. Here we sold off, but not as drastically, so we kind of faded down a little bit. And then the last two candles, we reversed the last 2 hours or 120 minutes. So very similar, isn't it? Fast forward to now. So Friday, the 13th of February, notice how we're having a similar situation. We had a gap down. Notice this first candle of trading. Then this sideways consolidation into the entire day pretty much, right? And we're closing at 1962, around this 1962 to 1972 dollar range. But this morning what happened was we gapped down into this level, we sold off, and notice how we also here came to that 1901, 1905 area. And then we reversed from there. So what am I trying to say here? What I'm trying to say is that what happens on these days, at least on Fridays and Mondays, is that we close around 1975, between 1975, maybe a little bit less, to around 1962. So this seems to be the area where we have these rallies into the late afternoon, and then we give back a little bit, but this is where we seem to be closing. And then when we come back on Monday or Tuesday, what happens is that we have a gap down, right? And we find some temporary support around this 1905 area. We had it right here. Let me see here. Let me just try to do that. We had it right here. We had it right there as well. And we had it today also. But today was a little bit different. So, and here is where the change in character comes in. Let me see if I can find the arrow here. So notice how the first day that I'm comparing, which is the 4th, we had a major sell-off into this area. So we went as far as the $18 level. And then we just had a minor recovery into the end of the day. Then the next session, which is the 10th of February, we did not have this drastic move down, but instead we floated down slightly. But again, we also had a little bit of a recovery into the last 120 minutes. Today, we didn't really have this down move. We immediately moved up, and we even touched these highs, which is very bullish. And so if you wanted to go short, you could have easily been short right here intraday. But what I'm trying to say is we did not have this move down. So we see a change in character. We have a major move down the first time we saw this pattern. Then we had an intermediate move down, and then today there was no move whatsoever. What that tells me is that there are some key players who wanted to unload their position in oil. And what it's showing me is that the buyers are still there, but that player or whoever that institution is, it might have been multiple ones, not just one, but they are slowly, they have slowly sold what they have, and therefore we don't see this down move as much as we did before. So in other words, the supply is diminishing, but the demand is, at least based on what I'm seeing, still there. And so what this is showing me is that a lot of the key players that needed to unload are slowly exiting the oil market, and buyers are still interested. Now, I still wouldn't go out and buy oil because, quite frankly, for me, oil is too volatile, and especially in options expiration, you never know what's going on. But based on what I'm seeing, this is something that I will keep in the back of my mind and then watch the price in the future to see whether or not oil can have another push. Personally, I think oil ultimately wants to go lower, but the question now is, how is it going to do that? Are we going to have another push up, or are we going to immediately sell? Now again, nothing moves in a direct vertical manner, right? So it's possible that you have a little bit of a pop and then move down lower, or that you immediately start selling. Now on the daily, we are into resistance, which is the 50 moving average, and we are also hitting this level right here. So that $20 level does seem to be some sort of resistance. And again, if you look at the stochastics and the CCI, ultimately it's telling us that oil wants to go lower. So the question now is, what's going to happen? We see these little micro clues, if you will, that tell us that these sellers are slowly exiting the market, but at the same time, on the macro scale, oil is not looking too healthy. So keep watch on oil, and if nothing else, use this video for education.